Hey traders, Raghi here, and most of this week, as we wrap up this series on exhaustion and momentum trading, not really exhaustion versus momentum, although that choice has to be made at some point within the trading day or within the context of a setup. But here we're going to talk a little bit more about how they can contribute to confirming one another and helping you with a trade. So I'm going to go right back to the primary part of the day that I like to be a day trader, and that is the early morning part of the day. Of course, today we had non-farm payroll. Non-farm payroll is going to get the day started, get the volume started an hour before the bell rings, and I call it a caution day because it's going to have wider volatility, a little bit more uncertainty on the open. So ultimately what we had is, and I'm going to show you what the clearing range looked like for the first 30 minutes of the day. And there's a couple things that I want to be on the lookout for next week. All right, so we'll talk a little bit about what I did, but also what we're going to look at for next week. First of all, this is the second session this week that we had a much more compact clearing range. Now, how can I measure that? Well, the clearing range tool that I use, and by the way, again, there's nothing complicated here. All it's doing at 9:30 is measuring the high and the low until 10 o'clock, and then you can see here it's counting the points of that range. So just automating things that we could very well do manually. All right. So it's a compact range because compared to the historical price movement range of that time of day, looking back 6 months, this is really on the lower end of that range. So it's a compact range. Now, the problem with a compact range is that if that range is so much narrower than the historical average or even the historical high, the market can move lower as it did today before ultimately doing what I find we do more often than not with a higher probability, which is head right back up again. Now this zone you see here, kind of cutting the chart right there, that is the clearing range retracement from the morning. So you'll see we really didn't go anywhere today. It was kind of a choppy day, a little bit more bearish, but I wouldn't even call this bearish as much as it is the market saying, look, we typically don't trade as narrowly as 52, 53 points. We're just going to put in a wider range before we finally find where the lows are and the market starts to rally, which is one of the reasons why since June 10, I continue to talk about a bullish bias in the market. So today wasn't a great day in terms of being able to capitalize on the movement higher because we just had a more exaggerated move to the downside. So the challenge is going to be this. One, I can't control what the clearing range is going to look like. That's definitely not something we can control, but we can observe it. And if it's compact again, if it's a much tighter range, I'm going to have to think about alternative ways to find those lows, project those lows in a way to accommodate the more normal, higher volatility, not this compact stuff that we're getting. My hope and my thought is that this is really more of a lead up into July 4, that we're seeing some of this kind of compact clearing range action the last couple of sessions because we're in this truncated holiday affected week. So, volume has been a little lighter. Even the non-farm payroll reaction was pretty muted. And again, I don't say that arbitrarily or subjectively. I'm talking about historically what kind of price movement range would we expect on an 8:30 non-farm payroll. Or today's 8:30 would have been really normally, if this weren't a holiday affected week, we'd be talking about initial claims. So this market ultimately didn't go anywhere, but had I been looking at a less compact range, I still think there would have been a nice opportunity for a buy, but it just didn't transpire. Now, I want to talk about one other thing before we move on, and that is the fact that it looked like early on that the S&P might be ready for a more aggressive, what we would call a breach style of entry, right? What's another way of talking about breaches? Another way of talking about breaches is to call them breakouts, right? Breaches, breakouts, tomato. What we want is to see that the market has some sort of acceleration, some indication of acceleration. I do that with two tools. the propulsion tool, which you see right here. It's a free tool I make available to members. In fact, it was a free part of the TOPS class that I did. It's available free on TradingView. It's available free on Thinkorswim. It's available free on TradeStation. And who knows where else, because I've always made this available freely in the logic and everything else. So that fired off, telling us, wait a minute, there might be propulsion, and the blue or the cyan colored dot is something called conviction. It's part of a tool set from John, and what John did back in 2017, the month before I did my class with grab candles, John did a class with 10x candles, and they're measuring two different things. I get this question quite a bit, and what I say is you need an indicator set for momentum breakout trading confirmed by volume, and preferably even some kind of acceleration where two short exponential moving averages are crossing each other. And then you also want to have an indicator set for exhaustion trades. Now today we went with the exhaustion trade choice because the NASDAQ was not signaling that it was seeing the same kind of acceleration. So here's the takeaway. Number one, it's a caution day. Holiday affected long weekends are going to have unusual price action. It's a caution day also because of non-farm payroll. And what I found interesting is even though the S&P said, yeah, I'm ready to run, my feeling is the S&P is the dog, the NASDAQ is the dog walker. And unless I'm seeing a similar set of indications, the 3-8 crossing, and then some nice conviction dots as part of the momentum, all this green bullish momentum, that's the 10x, by the way, okay? If I don't have that on the NASDAQ, I can't take that on the S&P. So this is kind of a lesson of, did it make sense to wait for a retracement? It did. Could I have been even more conservative about the retracement because of the compact nature of the clearing range? Absolutely. Bottom line, this is a caution day that really behaved as one. But I wanted to point out some of the things that I'll be looking out for. Hopefully we don't deal with them next week, but some of the things that I'll be looking out for when I'm day trading at the beginning of next week, okay? All right, so I hope this series that we've done, the last 4 sessions of momentum versus exhaustion and understanding when to play retracements or pullbacks versus when to play breakouts or breaches, I hope that it's been really helpful. Again, the 2 sets of tools that I'm going to use my grab and my wave in more of that market trend. You know, are we going to get a pullback type scenario? Because if I'm not getting the 10x indicating that we're seeing the likelihood of a breakout, that I'm not seeing the kind of conviction via volume at the key levels, at the key obstacles that we need to break at those thresholds, then it's going to be better off to wait for a pullback entry, all right? And that's where we go back to things like our V-score. That's where we go back to, okay, can we find lows on the V-score, the standard deviation measurement of the VWAP to help us out? You know, but again, pretty tricky day, but we'll talk about exhaustion versus momentum, or the way that I really would like everyone to look at it is exhaustion and momentum coexisting on your platform, and you know which gear to shift into based on what we get every morning, all right? Okay, gang, hope that helps. Have a terrific long weekend, and I'll see you in the next update.